Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So the Federal Reserve just announced it's raising interest rates by another 0.75% starting immediately. That sort of falls in line with what has been a historic pace at which they've been increasing rates this year. They say with an attempt to try to lower inflation, but I do find it interesting that in congressional testimony, Chairman Powell earlier in the year, when asked on direct questioning, will increasing interest rates lower the price of gas or food, he begrudgingly said no. So it's a little frustrating that the Federal Reserve continues to raise interest rates, saying that they're trying to lower inflation, when they acknowledge that the things that most people are feeling inflationary pressure on aren't going to be impacted. And so I want to talk just for a second about how it's going to or could lower inflation. And it's not a good story. So sorry, I sort of gave you the punchline at the beginning. If the Federal Reserve continues to raise interest rates at its current pace for a few more times, they're basically going to make it really hard for most businesses and individuals to get loans in the United States. And as a result, economic activity, the demand or the ability for people to have jobs and be wanting to purchase goods and services will fall. So demand on goods and services will fall. And as we've recently seen with gas prices, when gas prices got high enough and people stopped buying as much gas, the price fell, rather quickly. So this is potentially their plan is to slow the economy down to the point where there's not enough demand on the goods and services that are available today to keep inflation high. Personally, as a growth side guy, I would much prefer the Fed take actions to try to stimulate economic activity to grow our ability to produce goods and services, but that doesn't seem to be their plan. Another thing that I'd like to see them do, which they don't seem to be talking about or doing much of, is reducing the money supply. Because after all, the amount of currency in the economy is in my opinion, the primary driving factor for inflation, because we have way too many dollars that were injected into the economy over the last year and a half, 2 years, as a result of all the pandemic spending, while at the same time, holding down through lockdowns our ability to produce goods and services. And that, in my opinion, is the biggest driver of inflation. So if the Fed took more steps to try to reduce the money supply, that could have, I think, a more rapid impact on inflation. But I'm not king of all things. I'm just a guy who has to follow what they're doing. So I did receive several comments from my last update where people are like, gee, Todd, you're normally so optimistic about, the prospects for our country and the economy. And I think I may have left people with the impression that I was maybe pessimistic, and I'm not quite there yet. So I'm not pessimistic. I don't think that the end is near and it's a foregone conclusion that the U.S. economy is going to tank. But I do think that we're headed down a path at a rate that I haven't seen in the almost 20 years that I've been doing this, where the government is actively taking steps that appear to just be directly aimed at slowing down the U.S. economy. It's a little shocking considering the situation that we're in right now from an economic standpoint is 100% caused by the government in the first place, right? And you can argue that everything that was done during the pandemic for lockdowns and spending and all that stuff was what needed to be done. But the direct consequence of it is the inflation that we're seeing right now. So it is odd to me that the government has caused this problem, and now the government might actually make the situation worse by increasing interest rates at such a rapid rate. Just one example of the impact that it's having. Since December of last year, using the median priced house in the United States and a 30-year mortgage, the cost of a mortgage has gone up by almost 50% since December. So that's real. Now, oddly enough, it's not having as big an impact on the housing market as you might think, because at the same time, there is a relocation transition that's going on in our country, because more and more people are realizing that they don't need to live in these big metropolitan areas. They don't need to commute for an hour and a half or 2 hours, to work, to an office place. So why should I be living in a place that's super expensive when I can telecommute from a place that's less expensive? So we are seeing a lot of people taking money from larger metropolitan areas and taking them out into areas where the cost of housing is significantly lower. So, the average time that a house is staying on the market is still sitting pretty low at about a month, and that's pretty good. Now, the housing market isn't going to collapse because of these rising interest rates, because what's also happening at the same time is, while builders are not focusing as much on residential properties, they are switching over to multifamily. So, duplexes, apartment buildings, things like that. So from a construction industry standpoint, I'm not too concerned about like that collapsing, because we still have a shortage of housing. And if single family houses are not the thing that people are going to be able to afford while interest rates continue to rise, then multifamily becomes even more attractive as people need to rent. So I'm not happy with the Federal Reserve right now. I'm not happy with the federal government. There's an election coming up here, 6 weeks or so away. And my sincere hope is that we end up with divided government. I hope that we don't have one party controlling everything, because that just has led to, in almost every case that I can remember, extreme decisions, whether it's the Republicans or the Democrats. When one party controls everything, extreme decisions get made. And what we can't really afford right now is one party deciding that it wants to go spend, $1 trillion, $2 trillion, $3 trillion on their set of pet projects in an economy that's already flooded with dollars. That would just be a horrible decision. So I want to see a divided government so that we have less government action, and that will give the private sector more time to react to all the things that have gone on, rising interest rates, new regulation and new laws, and try to find some stability back in our economy. It's not a foregone conclusion that the U.S. economy is going to go into the ditch, but we are headed in that direction. And unless something changes here in the coming quarters, I'm going to switch from being a little less than optimistic to actually being pessimistic. But I'm not pessimistic now, because it is not a foregone conclusion that every dumb decision that could be made will be made. We are talking about the government here, so the odds might be good that they'll make every dumb decision that could be made, but I certainly don't want to be taking steps today in anticipation of that. What we are doing from an investment standpoint is we're starting to look at fixed income. Again, as interest rates rise, fixed income becomes a little more attractive. So we're migrating a little bit out of equities and into some fixed income plays. And we're also looking to put some protection programs in place that help limit the downside if the markets really decide to tank from here because of the actions of government and the Federal Reserve. So everybody who's invested, if you're not taking steps to address the reality of what's going on now, having a little more cash, we're sitting at over 10% cash right now. Taking steps to mitigate your equity exposure, looking at fixed income. If you're not doing those things, then you're literally just gonna ride along with the tide, and whatever happens, happens. So maybe you've got a lot of time and you can afford to go with the flow and ride the tide to wherever it takes you. But we just don't think that we necessarily should have to lose money just because we're going to sit idly by and let things happen to us. So long story short is we're starting to rotate to a little more conservative positions, not conservative positions, but a little more conservative, a little more protective, a little more fixed income. And we think that other people that are concerned about their portfolios might want to consider those actions as well. So if anybody has any questions about this, again, I'm not pessimistic, to be clear, not pessimistic, just not as optimistic as I've been. And if there were a continuum of, pessimism to optimism, where I've normally been is out here, I'm maybe somewhere in here now, right? I'm not like at the middle, but I'm more in here. And that's important for people to know, because again, it's not a foregone conclusion. We don't have to fall into the Grand Canyon. We don't have to go into the ditch. Actions still can be taken to mitigate some of these decisions and the economic impacts of them. But we're going to have to see. And so as time plays out, we will know. But I just wanted people to know that we are taking a little more of a conservative position, and we would recommend that for most other people that have any concerns about what's going on right now. So any questions about this or any other financial matter, please just send me a message, email, text me, whatever. I respond to most messages very quickly, and I'm happy to answer any question you might have. And that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.